The Rebel Capitalist Show.
All right, guys, it gives me a great deal of pleasure to bring someone back to the Rebel Capitalist Show. He is my good friend, Jason Burack. He is on top of the commodities. I just want to dive into it and get your thoughts on everything that's happening in the world today.
So over the last couple of weeks, the market has assigned very big geopolitical risk premiums for a lot of these commodities. And that was to try to bring on new supply outside of Russia and Ukraine. And then you had speculators piling on top of that, but the market was trying to assign with a higher geopolitical risk premium, a price signal to the market to bring on more supply. Now, a lot of private sector oil companies in the US, the mid-tier guys, so like your Pioneer Natural Resources, your Devon Energies, they were saying they would not bring on more supply. We've seen PR releases come out in the last 24 hours saying that OPEC will increase supply. We'll see if that happens, because over the last 7 or so months, and I wrote an article on this for patrons in the last month, OPEC was all talk over the summer. So they said they were going to increase production over the summer, and the numbers came out months later, and they really did not increase for oil production for more than a couple months. There are enormous structural problems with a lot of these OPEC countries that produce oil through the government entities, national oil companies. So these are very inefficient government-run oil companies. I wouldn't even call them companies. They're national oil companies, but really they're even less efficient than the Department of Motor Vehicles, except in this case, George, there is more assets for these politicians and bureaucrats and people in the military, like in Venezuela. And we could talk about some of the funny stories I've heard with waste, fraud, corruption, and abuse with these national oil companies in Brazil, in Venezuela, in Nigeria. You could go down the list that these assets are straight up stolen.
Yeah. Why are the U.S. producers not willing to produce more? Why don't they just jump on this and take advantage of these huge oil prices?
They're being very cautious because of the amount of capital expenditure it requires to increase oil production. So to increase oil production by 500,000 barrels per day, the U.S. private sector would have to spend enormous tens of billions, maybe even more than that, in capital expenditure to grow production that much. What most people don't understand is that actually around 70% of the world's oil reserves are actually owned by governments through national oil companies. So this is not talked about publicly. It's not polite to say that, because the narrative in public, whether you're on the mainstream financial media or you're on one of the fake news channels, and there's a bunch of them now, that's spewing war propaganda, it's that the private sector controls the oil. So, ExxonMobil, Chevron, those guys control the oil. That's not true. When you add up the oil production and the oil reserves for Chevron and ExxonMobil and those guys, it does not equal 30% of the global reserves and global production. So your Venezuela, Saudi Arabia, Iran, Iraq, Nigeria, those are the ones who own the majority of the world's oil reserves. And they run their national oil companies as inefficiently as possible.
Yeah, as all government agencies do. So the takeaway there is, when Biden comes out and says, hey, U.S. oil producers, we really need your help, produce some more oil because we're going to sanction Russia. The quote unquote greedy capitalists say, well, we'd like to help you out, Joe Biden, but not really, because if we spend all of this money to increase production, then it's not like a light switch where we just turn it on and off really quick. If we spend all this money, then oil goes back down to 90 or 80 or something like that, then we still have this excess capacity, and that's going to come off our profit and loss, and that's going to affect our shareholders. So we aren't very confident that the price of oil will remain this high indefinitely. So we just have to wait it out and see what happens.
Well, also the oil companies, and there's a narrative in public that with some of these governments anyway. So you have the UK government talking about windfall profits taxes. I think in Europe, they're talking about it. And Democrats here in the US are talking about windfall profits taxes on oil companies. But a lot of these oil companies have really only started to make profits back in the last 12 to 14 months. Chevron had record profits in 2021, but they had not had that amount of profit since 2014. So the majority of the oil and natural gas industry was not consistently profitable. What people see, though, is that the US grew oil production enormously during the shale oil boom. I would call it a bubble because it was not done profitably. The
Right.
Federal Reserve subsidized it, pension funds subsidized it, trillions of dollars were spent to grow US oil production. I think it was also done to protect the petrodollar, in my opinion, for during that time span, although now the petrodollar does not mean as much as it did 10, 15, 20, 30 years ago. But the US did not grow oil production efficiently and profitably back then. And the capital to grow oil production to those levels is not available again because investors for private sector oil companies, they want free cash flow, they want dividends. So oil production growth now will be done responsibly. But that means that the US oil companies are not going to immediately turn on the taps and grow oil production willy-nilly now. So Chevron and ExxonMobil, they have announced publicly, I think over the next 6 to 8 months, that they're going to try to, probably by the end of the year, increase oil production, I think 10%, and ExxonMobil said 25% here domestically. But that's not going to benefit people in the rest of the world. That's going to benefit gasoline prices here in the US. But there's such bad policy, George, by all these politicians, bureaucrats, regulators, whether it's in the UK, the European Union, and here in the US. We haven't built a new oil refinery, George. It hasn't been improved since the 1970s. So yeah, you can upgrade an old oil refinery, but you can't build a new one. And it probably at this point, with all the rules, regulations, taxes, red tape, environmental permits, it would be cheaper and more efficient to start from scratch and just build a new one, but they won't even allow it. So the costs and the time delays and all these permitting fees and environmental assessments that go into building an oil refinery, the US is just not so the US oil private sector, and we were discussing this before the interview, in my opinion, is still the best in the world at growing oil and natural gas production. Natural gas was in a bear market for years because of all that shale gas byproduct. And now, after the bear market, you see that there's a liquefied natural gas bull market for American companies. Cheniere Energy has all of their LNG exports booked through 2040 now.
Wow.
So the private sector here in the US, if they're given the opportunity to be entrepreneurs, to run their businesses efficiently, they can figure things out. Natural gas was in a bear market for many, many years. There was too much supply. And now there is strong demand globally for natural gas. You had in 2021, and this was shocking to me, you had the amount of electricity increase in 2021 by 6% globally. And that is despite all the pandemic, all these businesses shut down all over the world, and China intentionally shut down a lot of factories all over China, especially around Beijing, for 3 or 4 months before the Olympics. So in spite of all those things, you still had global electricity demand grow by a very high number, 6% in 2021. And a lot of that electricity inputs is not coming from coal. It's not coming from nuclear power, because a lot of these European governments are shutting down nuclear power plants. I think that's stupid. During an energy crisis, you have these announcements that these governments are shutting down nuclear power plants. Yeah. It's going to be coming from natural gas. So I think this natural gas bull market, it was built on enormous supply disruption, and now demand is starting to grow. And I think like long term, I think we have a nice natural gas bull market setting up, because I think natural gas is kind of the middle way for cleaner energy and for electricity generation.
Yeah, so let's unpack some of that. First of all, help me understand the oil production from A to Z, going from taking it out of the ground to putting it into your vehicle. Because I know, and correct me if I'm wrong, but I know the US can produce a lot of oil, but we have to import a different type of oil because we don't have the infrastructure here to take it from A to Z. Is that correct, or am I missing something there?
The refineries can switch, or at least some of them can. So I've been an oil analyst for my day job in the past. So back during the last oil bull market cycle, the oil refineries here in the US that were in the Gulf of Mexico area, so on the Gulf Coast, they actually wanted Venezuelan sour crude because the inputs, it was cheaper. So they upgraded their refineries back then to take in Venezuelan sour crude, heavy sour crude. So that's cheaper, thicker oil, it's more energy dense, and the input costs, that type of oil was cheaper than American oil and light sweet crude. However, things have changed though, because back then, I think Venezuelan oil production was still around 4 million barrels per day, and Venezuelan oil production has collapsed. And this is another problem why the oil market, why there's supply side problems. There's a lack of investment on the oil side because a lot of these national oil companies, George, have not made proper investments for decades into replacing, either finding new oil reserves and natural gas reserves and replacing production, because a lot of these governments have used the majority of oil profits for social program spending. So they've either subsidized gasoline prices for their citizens at dirt cheap prices. Like in Venezuela, they were literally selling gasoline. I think it was almost free. Yeah, gasoline for a long time in Venezuela was almost free. So domestic demand for gasoline increased enormously. And then you had all these cases where there was corruption, where Venezuelan politicians and military officials were literally filling up a oil tanker truck that people see at their gas station that fills up the gas there before they fill up their car or SUV. And then people would drive it, Venezuelan military people would fill that up for almost for free, drive it across the border to Brazil or Colombia, and then sell it at market price for millions of dollars in profit. And that's been going on in a lot of different countries. It's very, very inefficient. But Venezuelan oil production is only around, I think, the last time in 2019, before the pandemic, it was barely 1 million barrels per day. And the Chinese government, the difference between the last oil price cycle that was in a bull market in 2007, 2008, a big bull market, and this one where the oil price is going, well, it was going bonkers. And with the geopolitical risk premium, it was up $20 a barrel in a month. Is that China now has enormous claims on all of these OPEC producers. So whether it's Iran, Iraq, Saudi Arabia, Russia, the OPEC plus producers like Mexico and Venezuela, emerging market oil producers like Ecuador, China, over the last 13 or 14 years, they have locked up long-term supply contracts with all of these oil producing countries. So China has claims on oil production growth. So Biden going to Venezuela and Biden going to OPEC and begging, no wonder they're not going to pick up the phone and talk, because if they do increase oil production, China gets first dibs on it.
Right. That makes sense. And also too, if you sanction Russian oil, aren't they just going to sell it to China?
Or they're going to sell it on the black market for cash. Because if you're India and you desperately need gasoline, or you want natural gas for fertilizers, and you have dollars, you will buy it on the black market, because you do not want Arab Spring 2.0.
Exactly.
So
Can you
the
dive
black
into
market
that idea a little bit more? That's a crucial factor here. People don't understand that this is not just about oil and natural gas. It's about fertilizer, therefore food prices, therefore social and civil unrest.
Oh yeah, the Ukraine war right now, Egypt imports, I think, an enormous amount of Ukrainian wheat. So they have to scramble and they have to find other sources of wheat, because if wheat prices go up too much, the citizens could revolt, and then there could be a new type of Arab Spring. You just saw it in the news, I think a couple of days ago, Iraq, I think, is stockpiling 3 million tons of wheat for a strategic reserve. They went out and panic bought wheat from wherever they could. But a month ago, George, Russia is the world's largest exporter of fertilizer. They canceled. So I guess Putin was anticipating doing this. It was part of his plan to increase food prices and cause potential shortages. But Putin announced a month ago, and there's other countries doing it, but Russia's the largest fertilizer exporter. And Russia just canceled fertilizer exports through at least April, but the last couple of days, it looks like they're going to extend the fertilizer ban through at least the end of the year. And potentially we could see that for uranium and other commodities too. The uranium price just spiked. The uranium spot price now is back over $50 a pound. And Russia, the US nuclear power plants are relying on processed uranium from Russia.
Yeah, I just don't think the American public, or maybe the politicians as well, appreciate the leverage that Russia has, or appreciates how dependent the global economy is on Russia?
Well, Russia has some choke points for commodities, but it's really China. So if China decides they want to buy more commodities, then they're going to force the price up. And if China decides they don't want to buy commodities, then the price is going to go down.
So they're the main driver of demand, is what you're saying.
They're the marginal driver of demand, but the US can actually increase 6 months from now, George. The US can increase oil production. The shale oil producers can increase oil production. It won't be done at breakneck paces like it was in the past after 2008, from 2008 to 2019. And also at these prices, at these oil prices, the deep water companies and basically the entire industry, except for one company, went bankrupt for deep water. Actually, one of them, George, went bankrupt twice in 3 or 4 years. That's how bad, hated, unloved the deep water drilling industry was. But at the current oil price, the deep water companies, if the oil price doesn't crash, now we're down 12% today. If the oil price doesn't crash back down to $70, $80, $90 a barrel, the deep water oil companies are going to book tons of deals. They're going to go from enormous losses for the last 3 or 4 years. They're going to go to profits in the next 12 to 18 months. They're going to go to pretty substantial profits and more long-term orders, drilling rigs that are booked on higher lease rates. So that's kind of the call option. The deep water offshore companies, the ones that survive, and one of them is going to come out of bankruptcy again. And then I think they're going to list an IPO. That's Seadrill. Although like the last time they came out of bankruptcy, they had way too much debt, and I predicted that they would go bankrupt again. So we'll see. I haven't looked at their balance sheet to see if they're going to survive this time at high oil. But if oil prices don't crash and the deep water companies actually are more efficient, they would be the call option on oil prices staying at these levels or going higher if the supply problems continue to go bad and demand doesn't collapse.
What's their cost of production, and what's kind of the average cost of production for US and Canadian producers?
So you mean the shale oil guys or the deep water ones?
Both deep water and shale. I mean, I'm assuming shale is the majority of the supply that we have coming from the United States. If so, yeah. Is it $50? Is it $60? It sounds like it's more for offshore.
It is a lot more for offshore. So the cost for offshore used to be, and this was years ago before inflation and all the costs were going up double digits, the cost used to be $65, $70 a barrel. There were people that claimed that they could do it at 50, 55, but when you looked at their cash flow statements and you look at their financial statements, it did not show that. So they needed $65, $70, $80 a barrel to eke out a decent little profit. But now with the costs up, you're looking at $80, $90, $100 a barrel for deep water. But the costs are rising rapidly for oil producers. And this is the same for a lot of business owners now. So it's not just the oil industry. Mining costs, an enormous input cost for mining companies is diesel, is oil, is electricity. So if you're a mining company in an emerging market and your electricity costs went up 30, 40, 50%, and you were a low cost producer, your costs are going out of control. Now, maybe you can lock in a contract for a couple of years at a lower electricity generation price, or maybe you can figure out a way to lower your electricity costs with some investment. You're starting to see some of these mining companies now that are out in the middle of nowhere in Argentina, up in the mountains. They're buying giant wind turbines. So wind turbines don't make a lot of sense in most areas, but if you're out in the middle of nowhere in the mountains, like Palm Springs, somewhere similar geographically to that, you can lower your energy costs there. You can have some turbines around the mine, and that'll reduce your electricity bill, but you're going to have to pay a lot more upfront for that. But the oil companies, the low-cost producers in the US, and I was writing articles about this for patrons back in 2020 about the low-cost producers in case oil prices didn't go up that much, which ones would survive, which ones didn't have that much debt. You have Chevron and EOG Resources are two of the lowest cost producers. So those stocks have done enormously well. In 2021, they were some of the top performers. But yes. Now at the current oil price, George, you have the market as more risk on. So the higher cost oil producers, the ones with more debt, like your Occidental Petroleums and your Exxon Mobils, those ones are doing very well because the market is saying now those guys have more free cash flow. They're paying off their debt. So there's more leverage to the higher oil price.
How does the ruble crash? So we've gone from, let's say, 70 to, I don't know what it is, say 140, 150. So it's gone down by, let's say, 50% against the dollar. How does that impact the free cash flow for the Russian producers? Because their revenues are in dollars, their expenses are in rubles. If the ruble goes down by 50%, then technically their expenses go down, but they still have the same type of cash flow. That means profits explode. Is that correct? Or am I? And I was looking at a chart. Maybe you can confirm this the other day of producers, just kind of in general in the country. And this was back in 2015, so I think the ruble would have been maybe 50 around around that time. And back then, the average Russian producer, it was about $17 a barrel to produce. So, and that's in dollars. So if the ruble goes down by 50%, what is it now? Is it $8 a barrel? How do you see that?
A lot of these Russian companies, like you said, they can sell in dollars. They can sell in the black market. So they won't talk about this publicly because it looks bad. And the Russian companies aren't going to issue press releases saying, we're selling all of our oil in dollars on the black market. That would attract the US military, especially if they said who they were selling it to. But it's pretty common knowledge among oil traders that if there is a problem with a government, say there is sanctions with Venezuela, there is sanctions with Iran over the years, that they can find buyers in dollars for their oil on the black market. I've even heard stories of large oil companies in the past buying oil on the black market. I think recently with Russian oil companies, I think Royal Dutch Shell announced that they did buy some Russian oil from a Russian oil company in dollars. Yep. They got it at a discount. There was a negotiation done. It's temporary. These Russian oil businesses are fine in the long term. The Chinese government came in because the shares crashed, and one of the Chinese government entities just bought large stakes in the Russian oil farms because they are bargain. Yeah, they are bargain buyers. But if you're an American citizen, the government is just changing the rules. The retail investor got screwed. I've heard from friends that their E-Trade accounts and others, they can't even buy or sell the shares now. So I don't know if that's changed the rules. The rules,
unfortunately, frozen. They're frozen. I know because I own Lukoil as an example. And
the rules are
frozen.
I was warning my patrons about this in an article in the last week or two, that the rules are going to constantly change. So what's the rules today will probably not be the rules tomorrow.
Yeah. And to be clear, that's I don't own I own the ADR, I think it is, or the pink sheet that just owns the underlying asset. So it's still denominated in dollars, just to be super clear on that.
But I think let me add something here. I think the Russian stock market being attacked, the Russian currency, all these corporations coordinating things so quickly here in the West, this is a very sophisticated version of financial warfare. So I think like plunge protection teams decided to attack the Russian currency. This is more modern warfare than in the past. So we now have like financial warfare, like very aggressive financial warfare, because you can have a team of traders or they can even just program in high frequency trading algorithms to attack a country's currency or stock market by short selling. So I think that was involved. I think the Russian currency went down very, very rapidly. It seemed as if there was a government entity involved. I think a lot of these markets, there's a lot of government intervention in the daily trading activity that a lot of people would be surprised about.
Yeah, to me, as far as the corporations pulling out, that seems more like virtue signaling and kind of this cancel culture that, back in the day, right, when we were talking about COVID, you would have a company come out and specifically say that they're denouncing or they're doing the vaccine mandate or something like that, or they're taking a stance against racism or blah 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 blah, and they would do this just to gain favor in the eyes of the general public, the mob, let's say, on Twitter or social media. And it just seems like the exact same thing now with Russia. They've just moved from racism or Black Lives Matter. Now they've just moved over to Russia. I don't know if maybe I'm misreading it.
Or they're test running as they transition to central bank digital currencies and then a Chinese government style social credit score system here in the West, how quickly they can ruin someone financially.
Yeah, well, did you see today, I think Biden, the administration came out with their executive order or something like that to look into cryptocurrency, and Bitcoin spiked huge on the news, but I read through the bullet points. And to me, my takeaway was this has nothing to do with cryptocurrency, and it has everything to do with implementing a central bank digital currency.
Well, I'll just tell you here in the DC metro area, and I've been going to the DC Blockchain Summit, which was in person at Georgetown University until the pandemic. So I was going every year to that conference. There was government employees there from the Federal Reserve Bank, the US Treasury, the CFTC, the Securities and Exchange Commission. There was a lot of higher ups in the US federal government, and they own Bitcoin. Okay, so they don't necessarily want to talk about it publicly, although if you go to the YouTube channel for the DC Blockchain Summit, you can watch speeches from a lot of these guys talking about how much they love Bitcoin, but they just want it taxed and regulated more. So they are buying Bitcoin on the dip. They are speculating on it. There's so much hypocrisy here in the DC metro area because a lot of the people that are elected here and come here talk about socialism. They want to tax profitable companies. If the oil companies start making a profit, they want to screw them over. They want to put a windfall profits tax on oil companies, but that won't help with supply. And yet these people, all they do, like privately when the TV cameras are off, a lot of them are driving gas guzzling SUVs that are not hybrids. Okay, I see around here, I live in a pretty decent area in the DC metro area, and there's literally children, these are spoiled brat trust fund babies, driving around like $100,000 SUVs that are not hybrids. And their parents are like Democrat lobbyists, and they're hardcore Democrats. And then all they talk about is trading cryptocurrency on their phone, stock option stocks, the information trading. And we saw the Fed make an announcement on this recently that they're going to stop with insider trading on stocks. And Congress is talking about policing itself on insider trading on stocks. But the truth is that's how everyone here gets rich. They trade inside information. Information is literally peddled. So if you're on a committee or a subcommittee and your friends and family members, there's tons of information here that's leaked or literally sold or traded to profit off the stock market, to profit off rezoning of real estate. All of any scheme here in DC that's profitable, that's a racket, people are looking into it to make money off of it, which is why they're pushing the Green New Deal and infrastructure spending so hard, because the more spending that occurs here in DC, George, the more the parasites here in the DC metro area can steal.
Exactly. Cantillon effect.
Yep. The Cantillon effect. The Cantillon effect's also asset price inflation. So asset price, the Fed doesn't want to talk about this anymore, but we had the op-ed in November 2010 from Ben Bernanke about how good the wealth effect was. And he said the money supply would not increase. And he said it wouldn't create consumer price inflation. He was like, it's only going to be the good type of inflation with stocks, bonds, real estate. Yeah. It's going to make everyone wealthier. So they're going to go out and spend more and the economy is going to grow. And that was the Fed's narrative through the Alan Greenspan Fed, through the Ben Bernanke Fed, through the Janet Yellen Fed. And then we get to Jerome Powell, and then he starts reducing the balance sheet a little bit and increasing interest rates. And then boom, we get the 2019 repo madness crisis. And I don't know if you've seen some of the disclosures that have come out from the New York Fed since December of 2021. So a couple months ago, but there's a blog website called Wall Street on Parade, and they're going through these disclosures. And the stuff that's coming out is absolutely insane about the 2019 repo madness bailouts.
Yeah. Then the repo fails are spiking again. I just did a video on that. I'm going to do a whiteboard on it tomorrow. So we may see more volatility in the repo market in the days to come for sure.
Well, the Fed's going to have to, the Fed's narrative is that they're going to try to reduce the balance sheet because that's what you're seeing with a lot of these other central banks. So the Reserve Bank of Australia, the Bank of England, they're in this narrative that they're going to quote unquote fight inflation by raising interest rates a little bit, a couple quarter point rate hikes, or a small reduction, say 10, 20, 30 billion per month, maybe in bond purchases.
Well, I wanted to actually get your opinion on that, Jason, because I read today in the news, today is Wednesday, what is it, the 8th or 9th, something like
9th.
that QE officially ended. Did you see that?
No, I did not see that.
Yeah, so they've tapered, basically today was it. They tapered down to zero. And as of today, moving forward, they're not officially going to do quantitative easing. I wanted to get your opinion on how long you think that'll last.
First of all, there's official and then unofficial, because they're legally allowed now to buy and move off balance sheet whatever they want as of March 2020. Jim Bianco wrote that piece about the special purpose vehicles.
Yeah.
Also one of my contacts here in DC, and he posted this on Twitter. He said that he spoke with Federal Reserve Bank officials and they straight up told him that they have an additional 2 or 3 trillion in currency swaps and other liabilities already. So the Fed's official balance sheet is not the real number. So they're already lying. So yeah. he said for a fact, there's at least another 2 or 3 trillion on the balance sheet that the Fed doesn't want to publicly admit to.
Yeah, but I think a lot of their balance sheet, as far as how it affects markets, particularly the stock market, is kind of psychological. So do you think that will have a psychological impact on the market, being that they're technically not doing the $120 billion a month anymore? And then how fast do you think they'll reverse? Or do you?
My position is that if a stock market crash does happen, and we've seen this evidence since 2008 financial crisis, the Fed will issue as many press releases as it takes, and they don't have to spend the exact number, but they will issue as many emergency liquidity press releases, currency swap line press releases to foreign governments, foreign central banks, foreign corporations as it takes to try to get asset prices back up. There are structural reasons for this with the US Treasury budget deficits, because if the US Treasury budget deficit drops, like in 2008 or 2020. In 2008, I think in a very short amount of time, the US Treasury budget was cut by 30% with the stock market crash and the real estate crash. So there was a 30%.
Let me clarify there, Jason. Let me clarify, because guys, if you're not following what Jason is saying, he's talking about the Treasury receipts, i.e. the tax revenue. If the stock market goes down, tax revenue absolutely plummets. People think that it's really tied to wages and incomes. Not really. It's more so kind of correlated with the level of the stock market as far as how much the government is receiving in tax revenue.
So over the last couple decades, the percentage of capital gains taxes that the US Treasury is relying on has increased enormously. But if consumers stop spending, then for state and local governments, there's less tax revenue for people eating out at restaurants and people shopping at stores. So those tax revenues drop too. And then those states could potentially also be bankrupt, although they're going to increase property taxes and to try to make up the difference. But then they might go hat in hand to the federal government for bailouts. And this is why, George, that deflation at this point, post 2008 financial crisis, deflation cannot last with currency and credit falling, and then as a result, asset prices staying low for a long period of time because of how reliant the US Treasury is on capital gains tax revenues for stocks, bonds, and real estate. And deflation cannot be taxed by the government. So this is an important point. So all tax revenues at all levels of government collapse in a deflationary event the longer it takes. And I don't see government wanting to cut back. So what that means then is, in my opinion, and we've seen this with the Fed is the buyer of last resort of treasuries. But what that really means, what a lot of people on Wall Street and deflationistas and PhD Keynesian economists and bond fund managers that go on a lot of YouTube channels and talk relentlessly about their leveraged bond trades and how much money they're going to make, what they don't talk about is that the Federal Reserve Bank subsidizes all of these budget deficits. And the US is in a unique position because of the dollar standard, the demand for dollars, how much dollar denominated debt has to be serviced, and the world reserve currency, also the US military, because other countries cannot do the debt monetization subsidizing big government that the Federal Reserve Bank or the Bank of Japan can. So the Federal Reserve Bank is in a unique position now. I don't know how much longer it's going to last, where they can subsidize the size of big government. And anytime the stock market crashes, the real economy is in a mess, they are the buyer of last resort of treasuries. So when things crash and there is deflation for a short amount of time, in 2008, 2009, it was 6 to 8 months. In 2020 and part of 2021, it was only 6 to 8. I think it was 2020 was 6 to 8 weeks before we had a stock market rally. So the amount of deflation that they're allowing, which is debt deflation, bankruptcies, credit defaults, it is reduced because then the Fed has to come in and the Fed has to do even more QE in a deflationary environment because the Fed has to fund these government budget deficits.
But is it possible to have deflation in asset prices and inflation in consumer prices? What I'm thinking about is the 1970s. You know, you got 72 to 74. The stock market goes down by 50% in nominal terms. but consumer prices were still extremely high. So could we go into that environment today? And if so, could we see where CPI is increasing, but yet tax revenues are decreasing?
It is possible, but that would be worst case scenario for the Fed because the government is still spending more. The federal government level is still spending more. The state tax revenues would be bad. The states, a lot of these states, George, are increasingly more reliant on property taxes. So are people going to want to pay higher rents? If property values are not going up, are people going to want to pay higher property taxes? So at some point, there might be people just saying, I'm going to dump these properties, or foreigners are going to come in and buy it. Maybe the US government then offers some type of citizenship deal for foreigners who want to come in and buy even more properties to keep property levels that high.
Yeah, but then how does that play into oil prices, Jason? Because the oil prices, let's say they go up to 150 because of what Putin's doing or whatever is happening geopolitically, then that means that there's a good chance the stock market comes down because that's a lot less aggregate demand for other things, absent any UBI or way to direct cash or inject cash directly into the system. And so then you could have stock market coming down, but while consumer prices going up because of the higher energy costs. And is that something that is a potential liability for the United States pushing back on a Putin or XYZ authoritarian in the future? The fact that our economy is so dependent on those asset prices, and they, to a certain degree, have so much control over the price of our energy and our gas.
So I think a lot of this in 6 months from now, 6 to 8 months from now, will be resolved. I think oil supply here in the US will be substantially higher. And oil companies, private sector oil companies, we should not rely on OPEC. We should not rely on Venezuela for our oil production. We have, in my opinion, the best private sector oil and natural gas companies in the world. If politicians, bureaucrats, regulators do not sabotage them, do not break kneecaps, they can efficiently grow production and increase reserves, and they can do it environmentally responsibly as well. But if asset prices do stay low, George, I think you're going to see Congress, both political parties, panic if asset prices crash. And I think they will approve another stimmy check. Because a lot of these congressmen, a lot of people at the Fed probably already bought their out of the money puts. A lot of hedge fund managers probably bought their out of the money puts. People in here in DC probably already bought their out of the money puts for their hedge. That's, I think, why the VIX is still staying so high, is because there is a lot of people hedged right now. There is a lot of institutional money, professional money managers that have their hedges in place in case of a stock market crash already.
Right.
So I think the policies will change to try to inflate asset prices. What the average person doesn't understand is how often the rules can change. I mean, they could try dozens of things in 6 weeks or 6 to 8 weeks.
Yeah, I'd like to remind everyone that when the Fed came out and announced that they were basically going to buy junk debt in March of 2020, the market just screamed higher as far as the prices of junk debt. The yield went down significantly. And I was talking to Joseph Wang about this, and he said, what's fascinating is the Fed only bought about $1 billion worth of junk debt through that special purpose vehicle. But the fact that they just bought a small amount implied to the market that they were going to backstop everything. So the market did the rest of the work for the Fed. So do you think they could pull the same type of trick buying equities directly, and they would maybe only have to buy a very, very small amount, but just that what that means implicitly would psychologically prompt the market to just have an infinite bid on stocks for the next, however long until the market drives higher?
Yeah, the press releases are shock and awe.
Yeah,
but we don't really know all the stuff the Fed has bought because we're not doing independent audits. Ron Paul got a one-time partial audit. It was literally worse than a root canal. It was a nightmare trying to get a one-time partial audit.
Well, no, I know I've done it with Barnes. I mean, we sent in that FOIA request probably 3 months ago. Their deadline was February. and they still have not got back to us on our FOIA request. So I get it. You're preaching to the choir.
And Ron Paul had more access to the Fed chairman. Ron Paul probably got some people. He got John McCain and I think Bernie Sanders on board at the same time. I mean, I think, yeah, because he had to get both houses of Congress to agree to the bill. So that was the one time he got radical Republicans and Democrats to actually agree to audit the Fed, to look what the Fed was actually buying in 2008, 2009. Who knows what's off balance sheet with the Fed? These currency swap lines. And I was speaking with hedge fund managers last week. You have European banks now that made enormous amounts of loans to Russian private companies, and you have all the problems in the Russian economy. So these European banks could all have enormous counterparty risk. They could have big defaults on loans. And the European Central Bank has an ironclad emergency currency swap line contract with the Federal Reserve Bank. So if the European Central Bank needs trillions in emergency dollar loans, the Federal Reserve Bank has to credit their account. There's no vote with Congress. The citizens don't get to see this. The Federal Reserve Bank is under contract. There was a disclosure about this that was covered in a speech that the Gold Antitrust Action Committee, it was posted on the Bank of International Settlements website. A former New York Federal Reserve Bank higher up gave a speech talking about this at a Bank of International Settlements event gala. It was a party or something. And then Gold Antitrust Action Committee was the only one that covered this, talking about emergency currency swap agreements between these G7, between the Federal Reserve Bank, the Bank of Japan, the European Central Bank, the Bank of England. Those are really the 4 or 5 largest central banks where these emergency currency swap line agreements take place. So we don't know what the real amount is.
Right. But what you're saying there is the ECB does have some firepower to potentially bail out the European banks if there's just some systemic risks with those banks not being paid back by Russian creditors.
Exactly. And they might not even announce it publicly, though. So they would probably only announce it publicly if the shares of these European banks started to absolutely collapse. Then you would start to see press releases from the European Central Bank saying the Federal Reserve Bank has extended emergency currency swap lines. The banks are going to get emergency funding. The loans are going to be paid back. But bing, bang, boom, 6 months, a year later, the loans are magically waived.
Yeah, right. So
this is what happens in a fiat.
Is there's a lot. We just see the tip of the iceberg with the Fed's balance sheet, but there's a lot that's going on underneath the surface that we can't see that could lead to some of the prices we're seeing in other things, such as the stock market, or who knows, the European bond market, or corporate debt in Europe or something.
Let me recommend a book. So I don't agree with her politics, but I am friends with her, Nomi Prinz. She was a former managing director at Goldman Sachs, JP Morgan, and Bear Stearns. And she wrote a book a couple of years ago called Collusion Between the Central Bankers. And she actually flew down to Mexico and Brazil and interviewed central bankers, current and former. They spoke about the amount of bailouts, the real amounts of bailouts in 2008, and how Ben Bernanke was forcing a lot of these other central bankers in other countries to take the dollar so their own economy did not collapse. So they were taking emergency loans. He was threatening them.
Yeah. It makes it hard to decipher what is real, what's just noise, and what you should actually pay attention to try to predict the probabilities of XYZ happening in the future. I mean, maybe that's the best question, Jason. How do you do that? How do you sift through all the noise? How do you try to get to the bottom and find the truth in not just the media propaganda, but what's happening underneath the surface with all of these transactions that are happening in the shadows in the financial system?
Well, as an investor, it's different than trying to find out what's happening with the Fed behind the scenes, because that might not move the markets immediately. So as an investor, what I'm looking for is, I follow Sir John Templeton's investing philosophy. So I'm looking for top down, bottom up. I'm doing global macro, and then I'm looking at sectors and companies, sectors that are hated, companies that have better fundamentals in a bad sector. So with oil back in 2020, when oil was hated. And in 2 years, George, we've gone from negative oil prices low, cheap gasoline prices. In only 2 years now, record high gasoline prices.
Yeah.
That's an incredible swing in only 2 years. Shows how crazy everything is and how fragile the oil industry is. But at the time, I was looking for cheap oil companies that had good balance sheets that were low-cost producers to survive. For uranium, I was looking at companies like Cameco that could still make some revenue at a low uranium price. So yeah, they didn't have their two best mines running, but they were still acting like a hedge fund. They were going into the spot market in uranium like a hedge fund trader, buying cheap spot uranium for years and then flipping it at a long-term contract price to utilities. And that's what Cameco had to do to survive. That stock was at $8 I think like 2 years ago, and now it's at 20 something. So as an investor, it's a little different than actually like looking at all the crazy stuff the Fed's doing, because the Fed, a lot of the stuff's not going to end up being true, because a lot of the Fed stuff is propaganda, spin, lies. I mean, they issue press releases guaranteeing trillions in liquidity programs. And you said the reality is they hardly spent anything. But look, Wall Street loved what the Fed did, because the Wall Street investment banks get to manufacture more of these credit derivatives and junk bonds and other stuff. They get the junk bond salespeople get to get enormous commissions, bonuses. They get raises, they get salary raises, they get promotions at work by selling more junk bonds, by selling more credit derivatives to pension funds, to suckers. But without the Fed issuing the press releases saying that they were going to buy, and they didn't actually have to buy a lot, none of that would have happened.
Yeah, right.
So this is how the sausage is made. Wall Street banks love this stuff. They want to sell as many junk bonds and credit derivatives and collateralized loan obligations, leveraged loans, all this toxic sausage. And I use toxic sausage because a lot of the time people don't even know what's in it. I mean, look in 2008, these CDOs, collateralized debt obligations with the mortgage-backed securities, they were hiring PhD rocket scientists to chop this stuff up. So a lot of people in the banks themselves didn't even know what was in a lot of these products. The higher ups in the bank, they couldn't tell you all the exact stuff. So this is why, like the hedge fund managers for the Big Short, they were looking through the stuff that was in these things, and they were absolutely horrified.
Yeah, right. But that just goes to show you the complexities of the bank's balance sheets and how they manage it with, to your point, derivatives. I would also throw in credit default swaps to bring down the perceived risk of the asset side of their balance sheet, while in reality they're just adding more leverage, because those credit default swaps, could be off balance sheet, or those credit default swaps could be an asset or a liability on the bank's balance sheet, pending on the price.
Well, George, the banks don't want to hold a lot of this stuff. It's a game of hot potato or musical chairs. They want to create this stuff, make big commissions and fees selling it.
Yeah, right.
And they don't want to be caught holding it. Like
mortgages. People think that you get a mortgage from B of A or Wells Fargo. They don't realize that they're just a middleman. They facilitate the transaction and sell the paper to Fannie and Freddie before the ink's dry.
Well, what happened to this commercial real estate bubble? So there was over trillions of dollars in commercial real estate mortgage-backed securities. We have the economy under a heavy transition. I see press releases every day about restaurants and bricks and mortar retailers closing, moving things to a warehouse and online for online sales, people working from home. People are not doing as much normal types of eating out and shopping. You would think that this would cause an enormous commercial real estate default all across the United States. I just brought up Chicago because I saw a press release about like some premier shopping mall in Chicago, and I think it was $500 million a couple of years ago, and I think it just sold for 30 million. So it went down from 500 million down to 30 million. Yeah, and right. You would think that this would cause just wide scale trillions of dollars in commercial real estate default. And the banks were holding these commercial real estate loans, and the real estate investment trusts were invested in either owning these commercial real estate buildings, or they invested in commercial real estate mortgage-backed securities. The pension funds own them too. Where is the defaults? We haven't seen this wide scale default. I'm just pretty shocked. my educated guess, and I can't prove it because we don't have a Fed audit, is the Fed went and bought trillions of this stuff and stuffed them off balance sheet already and prevented the banks from having problems again.
Right. So they're not, the banks and the pension funds and the hedge funds aren't taking the haircut. The Fed is, and they have an infinite balance sheet. So who cares?
That would be my educated guess, but there's no way to prove it because there is no real transparency with what the Fed is actually doing now.
Yeah. That's a great point. All right, my friend, I think we've gone an hour here. Tell everyone where they can get more of your incredible research, insight, wisdom, experience. I mean, every time I talk to you, it just gives me so much to think about and so much value. Where can people go to get more value that you create, more content?
We didn't get a chance to talk about gold and silver, so there's tons of articles behind the paywall for patrons about precious metal royalty and streaming companies. This business model, you do not have to worry about oil prices going to $150 and destroying the profit margins for miners. So these gold and silver companies, they have a much better business model. Their profit margins are protected compared to regular mining companies. I have over 200 in-depth articles and audio podcasts behind the paywall for patrons for only $5 a month, trying to make sure I make a decent living there and give people affordable research at a good price. I'm not trying to rip anyone off here.
No, it's a no-brainer. It's an absolute no-brainer. I mean, you guys, if you're interested in gold miners or royalty companies or the oil companies, I mean, you have to go to Jason's Patreon and subscribe for his premium service. I mean, $5 a month, that's a you can't afford not to really hit that price. So you guys have to check that out. What else do you have there, Jason?
Well, it's not half-assed. There's been winning trades the last 2 years. Just in the last month or so, I actually picked out, I think, the top or one of the top performing oil and natural gas stocks listed on a U.S. exchange. It was a liquefied natural gas play. And U.S. liquefied natural gas plays, as I talked about earlier in the interview, there's only a couple of pure plays for that. They are booking contracts like crazy because of the energy shortages and rapidly rising natural gas prices in Europe. Yes, liquefied natural gas is expensive to pay for long-term contracts, but it's better to have supply and better to have electricity than no supply and not have electricity or heating during the winter.
Yeah.
So I would rather pay a little bit more. Here in the US, we have stagflation. In other countries, the electricity bills are up way more than that. I've heard stories from friends in the European Union, United Kingdom. There's also almost 2,000 free YouTube videos on my YouTube channel. A lot of them are shorter, although I've been putting out a couple longer in-depth interviews in the last month or two. I interviewed Kyle Bass back in November, and I just interviewed a silver expert about supply side problems. And this is a key issue here. There are a lot of supply side problems for commodities, especially food, energy, industrial metals. There is a big silver shortage coming in the next 3 to 5 years because silver industrial demand is growing enormously. I just interviewed a silver expert. Yeah. And he said that over the next couple of years, if silver industrial demand continues to increase to current levels, it either stays at current levels or increases. It will take up 80% of annual silver supply in the next 3 to 5 years. So that means, especially with higher mining costs, the silver price is going to have to be substantially higher in the next 3 to 5 years.
Yeah. So you've got your finger on the pulse of all of that and much, much more. So people, the YouTube channel is Wall Street for Main Street. Is that the Patreon page, or is the Patreon page Jason Burack?
It's patreon.com/Wall Street for Main Street.
Okay. Yeah.
You could just put a link there for the video.
Yeah, we'll do. All right, buddy. Well, awesome conversation as always. Can't wait to do it again. And I'm sure next time we talk, there's going to be a lot to discuss. It's it's one of those years that I said right at the beginning where I think we're going to see a lot of stuff happen, and that's exactly what we're seeing play out right now. So,
the last 2 years have been bonkers.
No kidding. I mean,
but it started with the repo crisis. Before the pandemic, it started with the 2019 repo crisis because a lot of banks and hedge funds failed. There was, if you believe the numbers, there was at least 19 trillion in bailouts during the 2019 repo crisis, including a Japanese investment bank, Nomura Securities, that is not that big. And they were playing big boy games with like Goldman Sachs and Morgan Stanley and JP Morgan and those guys. And at one point, they had $4 trillion outstanding in repo loans from the New York Fed. This is a Japanese investment bank playing in the derivatives market on leveraged bond trades or currency swap trades, leveraged derivative trades, and they got an absolutely enormous margin call. The Fed probably bailed them out too.
Yeah, it doesn't surprise me. It doesn't surprise me at all. I mean, the same thing with nickel. I mean, who would have guessed that? And that's just a result of all these banks hedging and trying to manage their balance sheet and just using as much leverage as they possibly can, getting around regulations like Basel III. I mean, it's just you've got this inverted pyramid that's a derivatives market with so much systemic risk, and you just don't know what block at the bottom needs to give way for the whole thing to collapse. And when you've got oil going to $150, and what is that going to trigger? When you've got the wheat price going up by 50% or whatever, what is that going to trigger? When you've got the sanctions on Russia, what type of systemic risk is there in the European and global banking system? I mean, these are things that we just don't know about, but unfortunately, I think we're going to find out very soon.
I agree.
Yeah. All right, man. Enjoy the rest of your day, and we'll talk to you soon.
Thank you very much. I really appreciate it. Keep up the great work, George.